Good morning and thanks for tuning in. This is Stocks to Watch on Bloomberg Quint and I'm Alex Matthew. My guest today is Mayuresh Joshi, the head of equity research at William O'Neill. Mayuresh, good morning. The first
Morning.
stock that I want to talk to you about is Axis Bank, and it's been in the news recently because of the fundraising that it did. But the latest is that it will be buying less of a stake in Max Life Insurance than was originally planned. And according to the revised terms of the agreement, Axis will buy 17% instead of 29% that was earlier planned. What does that mean for Axis and indeed for the Max group? And could that be interpreted as an effort to conserve capital at an uncertain time, or is there a regulatory angle to it?
Good morning, Alex. First of all, thanks for having me on your show. No, I think the two elements that we are probably looking at is one is related to the deal itself, and second is related to the standalone performance that both these entities are expected to perform. When you come to the deal part itself, yes, the initial contours of 29% being bought in, and then some question marks that were probably being raised by the regulators. There was an element of overhang or a risk factor whether the deal will go through in the first place. Now that the deal has gone through, albeit at a lower percentage at 18 odd percent, where Axis already has won and will buy 17% more, there is some amount of sanity that will come through in terms of the deal expectations. Now, from a balance sheet perspective, obviously, I think there will be less capital shedding that Axis Bank will have to do at this point of time. Plus, I think it gets a fair share in the insurance business as well, because it was one of the biggest bank insurance partners for Max Life as far as the insurance segment was concerned. So on this part itself, I think some respite for both the players from a total no-no to at least some portion being allowed to be taken in. The second element then comes to the standalone performance for both the bank and the life insurer as well. So for the bank, I think the asset quality has been improving, albeit at a very slow pace. So if you look at the BB and below book, both funded and non-funded for the bank, it has come off marginally. But the best part, I think, for the banking sector as a whole, including Axis Bank, is that the moratoriums have actually come off significantly. So I think the moratorium book at 9.7% is a clear indication in terms of the asset quality pressures that were expected to play out on the banking sector, and particularly in some of the larger banks. They're not as prominent as seen. Loan growth has obviously moderated both on the retail and the corporate part, which has led to a slowdown in terms of the overall CASA ratio for the bank. But NIMs have held up at 3.4, 3.5%. And the large expectations in terms of the steady deposit growth, along with the steady advances growth with strong underwriting, should support NII and the book value going forward as well. So yes, fundamentals are supportive. The deal should be value accretive now that it has gone through over the next few quarters. But as per our methodology, I think we'll still wait for some more price action and some price strength in terms of both EPS rating and the RSI rating for the stock.
Understood. Sticking with the banking space, Mayuresh, and we're talking about India's largest lender. It's reclaimed that 200 rupee mark, and based on what I've seen, there's a little bit of disillusionment, at least in the retail side of things, where people are saying perhaps they've not been rewarded as much as they thought they would by holding on to SBI. But then there's this Goldman Sachs report that I was reading that's changed the rating on the stock to buy from neutral and significantly raised the target price, saying that it is well placed in terms of the provisions that it's made for bad loans, and in fact it is undervalued compared with the private sector peers. That of course is a given as things stand, but what's your rating on SBI?
No, there are no two ways about it, right? From a valuation perspective, obviously it's very undemanding at this point of time. And all the concerns that are getting played out for the public sector enterprises, SBI included, is how the asset quality trajectory will play out. And whether I think a lot of the pain in terms of key asset recognition has been done. If you look at two broad parameters, specifically in the case of State Bank, the PCR, the provision coverage, has in fact improved to 86 odd percent. So if you go a couple of years back, it was languishing around 60, 65. So they've done healthy provisioning over the past 2 years, and that has really strengthened their balance sheet. Now, the second element, as we were discussing in the case of Axis Bank on the banking sector as a whole, the moratorium book, even for SBI, has come off significantly significantly. So at 9.5%, right from 20-23% a couple of quarter back, you're probably seeing huge improvement happening in terms of the availment of corporate accounts within the moratorium book itself. The third element that everybody is a little bit stressed out when it comes to PSU enterprises is the capital adequacy. And the Tier 1 ratio clearly stands out, which is far more healthier compared to a lot of other banks within the space itself. So at 11.2% within that range, I think Tier 1 ratio is good enough to probably have a steady advances growth. Deposit growths have been steady for the bank itself. They've been maintaining a very, very healthy CASA ratio itself, and the NIMs and spreads for the industry as a whole, including State Bank, should also hold up. So, in my opinion, again, I think on an adjusted book value on a standalone basis for the bank itself, there is enough parameters for growth going forward. And if you take into account the subsidiary performance as well, SBI Life, Asset Management, SBI Cards, my own sense is that there is sufficient value that one can derive from the subsidiaries as well. So there is enough value derivation that you can probably do for the bank itself. But like in the case of Axis, I think our methodology will still suggest that let it pick up some price action from an EPS and an RSI perspective, and then we'll probably have a look at it.
Speaking of price action, Mayuresh, the third stock, Deepak Nitrite, it's Director General of Trade Remedies a little while back did find preliminary evidence of dumping of phenol by US and Thailand companies and recommended a provisional anti-dumping duty. We're still waiting on the result of that recommendation. But Deepak Nitrite is, in fact, India's largest producer of phenol. And we saw yesterday in trade, it absolutely bolted. So my question really is that for the retail investor who's been on the sideline right now, should they try to clamber onto a horse that is already bolted? Or how do you play this?
No, you need to give it time now, because I think the kind of move that you probably saw yesterday, I think it was a phenomenal move. So I think a lot of stocks in the broader markets are giving you phenomenal moves on a daily basis. Now, for the stock as a whole, within the chemical stroke specialty chemical space, the basic chemicals for Deepak Nitrite did hold on. Now, when you're probably talking about the margin profile for each of these individual segments, I think the margin expectations of 20-22 or 23% being maintained, I think that should be a possibility for this segment as well. Now, a couple of segments which probably had a little bit of a languishing effort was the performance product segment. And obviously, I think the industries that they cater to, paper, textiles, I think they're going through some element of pain at this point of time. The other industries are holding up at this point of time, which is your home care, detergents. But I think paper, textiles will take some time. So PP margins will probably take some time to recoup. At the same time, I think the oversupply for DASDA is clearly something which will also impact the margins on that segment. However, I think the phenol segment and the phenolic segment that Deepak Nitrite has ventured into a couple of years back, and the capacity expansion that they did at the right time, the spreads that they're enjoying, albeit a little bit lower at this point of time, and which remain extremely volatile, I think that segment can do well, because the capacity expansion in downstream operations that they're doing, the isopropyl alcohol facility that they have done, and expansion thereof, along with, I think, the backward integration for value-added derivatives of acetone, I think those segments can prompt up the margin going forward. So I think debottleneck for key segments going forward, expectations of key segments holding up, offset by some segments which will drag the overall margins. I think it is in a sweet spot from a long-term perspective. But I think the run-up, Alex, in my opinion, has been very, very sharp. And therefore, I think investors, if they want to get into the stock, I think they should actually wait for some amount of pullbacks.
Fantastic. As always, thank you so much, Mayuresh, for joining me and for helping our viewers out. And to you, dear viewers, thank you so much for tuning in. I hope that this conversation helped you out. There's a lot more coming up in